If you're new to investing, jumping into the stock market can feel like trying to read a foreign language, right? Well, today, we're going to be your translator. We are breaking down 10 of the most common and honestly, most confusing terms you're going to hear. By the end of this, you'll be able to navigate the market with a whole lot more confidence. Let's dive in.
So you've definitely heard these terms thrown around on the news. Bull market this, bear market that, but what does it actually mean for your money? Is the market charging ahead, or is it getting ready to hibernate? Getting this one concept down is seriously the first step to making sense of everything else.
All right, first up, let's get a feel for the overall environment. You can think of these first few terms as describing the market's mood. Is it happy and optimistic, or is it pessimistic and scared? This is the big picture.
Okay, the imagery here is just perfect. A bull market. Think of a bull thrusting its horns up. Things are good, prices are rising. And look at this, they tend to last for years, with average gains over 100%. Now on the flip side, you've got a bear market, like a bear swiping its claws down. These are tougher, for sure, but they're also much shorter, and the losses, while painful, are historically smaller than the gains. And that is so important for long-term investors to remember.
Now here's something you absolutely have to know. A downward trend is never, ever a straight line. You get these little rallies, these bounces along the way. And one of these bounces has a very memorable name that serves as a huge warning to investors.
And here it is, the dead cat bounce. Yeah, the name is a little grim, but it's based on that old saying that even a dead cat will bounce if you drop it from high enough. In market terms, it's when a stock that's been crashing suddenly jumps up. It tricks people into thinking, okay, the worst is over, time to buy. But really, it's often just a temporary blip before it continues its slide downwards. It's a classic trap.
Okay, so now let's pull back the curtain a little bit. We're going to talk about one of the biggest, if not the biggest players influencing the market's mood, the U.S. Federal Reserve. You'll just hear it called the Fed.
There is this old mantra on Wall Street, and it's incredibly powerful. Don't fight the Fed. What it really means is that the Fed has so much power to control the money supply that its decisions can basically overpower everything else. When the Fed wants the market to go up or down, betting against them is, well, it's a very, very risky game.
So how do they do it? Well, think of it like they have two main levers. On one side, you have quantitative easing, or QE. This is basically the Fed creating new money out of thin air and pumping it into the economy. All that extra cash looks for a home, and a lot of it finds its way into the stock market, which pushes prices up. The opposite is quantitative tightening, or QT. That's when the Fed is pulling money out of the system. Less money floating around usually means stock prices get pushed down.
And if you want to see just how powerful the Fed is, look no further than 2020. I mean, think about it. The economy was a mess, right? GDP was down, unemployment went through the roof. Logically, the stock market should have crashed and burned, but it didn't. It went up 18%. Why? Because the Fed was deep in QE mode, flooding the system with cash. It's an incredible reminder that what the Fed is doing can sometimes matter more than the actual economy.
Okay, we've covered the big macro stuff. Now let's zoom in. Let's talk about the individual's toolkit. These are the terms and the strategies that you can actually use to build your own approach to investing.
One of the best risk management strategies out there, especially for beginners, is dollar cost averaging, or DCA. Here's the idea. Instead of dumping all your money into a stock at once, you buy in smaller chunks over time. So if the price drops after your first buy, guess what? Your next purchase is at a lower price, which brings your average cost per share down. It's a fantastic disciplined way to invest that stops you from trying to do the impossible, which is perfectly timing the bottom.
Now, pretty much everyone gets the classic buy low, sell high plan. That's called going long. But did you know you can also make money when a stock's price goes down? That's called shorting, or going short. It kind of flips your brain inside out, but here's how it works. You borrow shares of a stock and immediately sell them at the high price. Then, you wait for the price to fall. Once it drops, you buy the shares back at that new, lower price, return them to the lender, and you get to keep the difference. It's the same logic as going long, just completely in reverse.
And finally, let's do a quick lightning round of a few more tools for your kit. First, tax loss harvesting. This is a smart move where you sell some investments that have lost money to help cancel out the taxes you'd owe on your winners. Then you've got support and resistance. These are key price levels on a chart. Support is like a floor that a stock price seems to bounce off of, and resistance is like a ceiling that it struggles to break through. Super useful for technical analysis.
So there you have it, 10 key terms to get you speaking the language of the market. You see, it might seem complicated at first, but every single one of these terms is just a label for an idea. And once you understand them, you're not just an outsider looking in anymore. You're an informed participant. In this game, knowledge is your single greatest asset. So the only real question left is, what are you going to do with it?